Hello and welcome back to Game of Trades, your number one channel for information on the stock market and cryptocurrencies. If you are new here, make sure to hit that subscribe button because I'll be here helping you navigate through this crazy market every step of the way. Now, in the last video that we made covering the stock market, the markets were selling off very hard. We were coming down from above 4,200 points all the way down to 4,050 points. Everyone was panicking. Meet Kevin made a video about a 20% correction in the stock market. CNBC was talking about margin calls triggering more downside. But we looked at the charts. We saw the markets were at support right here at this strong long-term level. This trend line goes back a decade. We looked at the volatility index, which was testing resistance right there of that price channel we've been looking at for months. So that was bullish for stocks. And we looked at the dollar, which was also testing resistance. We had the dollar in a big downtrend for the past few weeks. And that correction in the stock market was just a little counter rally in that downtrend of the dollar testing resistance before getting rejected and resuming that downtrend, which is again bullish for the stock market. We also took a look at the bond market, which was selling off hard during that correction. So we saw both the stock market and the bond market sell off at the same time. That doesn't typically happen. If you're expecting a large correction in the stock market, right, that's usually accompanied with a rally in bonds, which is not what we had. So we didn't have much to be worried about here. So in today's video, we're going to talk about exactly what we're expecting in the next few weeks. What are we watching on the charts? Again, if you haven't already, make sure to hit that subscribe button. And now without further ado, let's get right into it. So just a quick overview of the technical picture on the S&P 500. I'm going to put up a longer term chart here. So this is still the daily chart, but it goes back further. We can see this price channel we've been looking at, that clean breakout we had back in March. And so far the back test of that channel. And by the way, this is something that we've been talking about over the past couple of months, ever since we broke out of this bull flag. We saw that big breakout. Market started to get overextended here. We hit that resistance level. We said the markets were risky right here, very risky, and we were expecting a back test. So that's what we're doing right now. Just from an objective technical standpoint, this is all very bullish price action. We have a breakout and back test of an important price channel support, price channel resistance. So as long as we remain above that level, the markets are looking great. We're looking for much more upside on the S&P 500, which is typically what you get when you break above a significant level like that, right? If you stay within the channel, then you can only expect returns that are allowed by the channel. But now we're above that channel, so the sky is the limit in terms of what levels we can reach on the S&P 500, and that really fits in to the bubble price action that we could see over the next few months as we reopen, as we start getting vaccinations, and yet monetary policy stays easy, liquidity remains high and pushes assets higher. And we keep that narrative as long as we stay above that level. If all of a sudden we start breaking down here, right, and back testing, seeing this type of move, that would be extremely bearish. And I'm about to show you a couple charts that are going to show you exactly why that would be so bearish. And I'm going to start off with the S&P 500 divided by the M2 money stock. And so this is a very important chart. Let's zoom out. This is a weekly chart, right? Going back to the 1990s, capturing that dot-com bubble, 2008. And so what we have here is the S&P 500 relative to how much money is in the system. And it gives you an idea of how overvalued or undervalued the stock market is relative to monetary policy. And this is the chart that we're really going to be watching over the next few weeks to see exactly what happens here. Because look at this chart. We have a beautiful line of resistance, or let's call it a resistance zone, that really got shaped in 1996 and back tested in 1997, 1998, and many other reactions along the way, including the 2008 top and the 2019 top just before the COVID crisis hit. And now in 2021, look where we are. We're right at that resistance level, testing the exact same level we were in 2020. So this needs to be watched. We are right at that borderline between bubble territory, right? Because the only real moment where we went above this resistance was during the dot-com bubble, and healthy market. Throughout the last 20 years, except for this brief period, we were within this trading range here. So if we have a strong rejection right here, then that'd be a very bearish technical development. We'd be looking for a larger correction, perhaps down to these levels at 0.2. That seems to be the closest line of support. And that could be a 10, maybe even 15% correction in the stock market. And that would actually be healthy price action. But if we break out here, then we're getting into that danger zone where we were back in 19 all the way to 2000. So you're probably waiting for me to tell you what we're expecting, or else you wouldn't be on this channel. We give you guys our convictions. We give you guys exactly what's going on in our minds, and we're transparent about it. So what we expect is this ratio to actually break out. Now, I wouldn't put 100% probability on it. We might have a brief correction, a period of consolidation, or a brief correction before breaking out. But we do think that's a real possibility. Monetary policy is easy, and we're about to see a lot of optimism around the reopening. And when you look at margin debt skyrocketing, it reminds you of speculative behavior similar to what was happening in 1999, and that could actually fuel much higher highs in the markets. So in terms of technical analysis, what we're looking at on this chart is this level here at 0.21, right? I've highlighted two levels here, one at the top of the resistance zone and one at the bottom. And you can see so far in these two red candles, we've closed both times within that zone. So we're consolidating within that zone. That's pretty bullish so far. If all of a sudden we have a breakdown and we close below that line, for example, this week we have one more dip and we close below here, that's looking bearish, and it would increase the probability of more downside in the market. So that's what we're looking at on this chart. Now, the next thing that I want to discuss is you hitting the like button as hard as you can. These videos do take time. We put a lot of research into this, so don't hesitate to take just a couple seconds to hit that like button and help out our channel massively. Now, I want to show you another very important chart, which is the Dow to gold ratio. So let's put up the Dow Jones, and we'll divide the Dow Jones, which is the stock market, by gold. And so now, instead of having a stock market that rises non-stop over time, you actually have a stock market that's a lot more reasonable and that goes sideways over time. You actually have a stock market that doesn't go up that much over time because you don't measure it against the dollar, which devalues over time, right? You measure it against gold, which has steady value. Gold is a storehold of wealth. It keeps its value. So when you want to know the exact performance of the Dow Jones, measure it against gold, not the dollar. So let's take a look at what's happening on this Dow to gold ratio. We can actually put a trend line on this chart going from that high here, capturing this reaction in 2018, and you'll see where that takes us. Let me clean that up very quickly right there. You can see we've just been rejected off that trend line right now because we've seen a small correction in the stock market and we've seen gold break out massively. And this is exactly what we've been talking about with our members on gameoftrades.net. We've actually posted a lot of articles talking about gold outperforming the stock market, right? These are all articles that we have on the site. Debt to GDP and how the US dollar is going to devalue, the fundamental case for gold, stocks versus gold, money supply and gold, precious metals 2024 targets. So we're really happy about this rejection because that fits very well into our longer term investment narrative. Now, if you want to find out more about our long-term investment thesis and check out those articles we have, make sure to go and check out gameoftrades.net and sign up to our free trial if you want to test out our service. So now you're probably wondering what this means for the stock market. Does this mean that the stock market is going to crash right now? And taking a quick look at this chart, I mean, in 2000, this ratio peaked right at the top of the dot-com bubble. In 2018, that was before the repo crisis. So just at a glance, this type of rejection would be bearish for the stock market. But we don't want to just take a glance at it. We actually want to get into the data and see what this means. So I'm going to put vertical lines in areas where this ratio peaked in a similar way to what happened here. And I want to specify that because this is not a similar peak. This was a massive reversal where this ratio went on from being in a strong uptrend to being in a strong downtrend. What we're having now is just a lower low within this ongoing downtrend. So we want to compare other points on this chart that are similar to what we're seeing now. So let's put vertical lines in those areas. We have a peak in 2004. That was a big lower high. We had one in 2007 right there. Now we can zoom out to the previous bear market in the Dow to Gold. And we had one in 1976 right there. And in 1971, that's a similar peak in this downtrend. So let's already take a look at those 4 points and see what happened with the stock market throughout those times. So here I've put the stock market, the S&P 500 in orange here. And you can see this first vertical line was right before the great financial crisis. So that was bearish for stocks. Here you've got a vertical line in 2004 during a healthy bull market. And you actually saw a big decline in the Dow to Gold throughout that period, even when the stock market was rising. Now let's go back a little bit further. Here we have a peak right there. The stock market was kind of flat to the downside following that peak, although we had a lot of inflation. So the stock market was actually going down pretty quickly, but in nominal terms, it was going sideways. And another peak here, which was followed by a couple years of bullish momentum on stocks. So there really is not a positive correlation here. We've got 2 data points out of 4 where stocks go down and 2 data points where stocks go up. So what's happening right now, although it's not particularly bullish for the stock market, it's not necessarily bearish just yet. There are times in history where the stock market goes up despite this ratio going down, and that just means that gold is extremely strong, which we expect it to be very strong in the next couple of years leading up to 2024. But if monetary policy stays easy throughout that period, we could see the stock market do relatively well despite this outperformance of gold. So in summary, from a technical standpoint, you want to be watching this trend line here. If we hold above, it's bullish. We also have a minor downtrend line here. If we break out above this level, back test this price channel support right there, that would be bullish. We do have a short-term technical damage, so we can expect a sideways period of consolidation before we see higher highs. That is possible. But if we break down here, look out below, because that would mean we're being rejected off the exact same resistance from 2007, 2019, and 2002 on the S&P 500 divided by the money supply. So I hope that clears things up. There's always 2 sides to a trade. You want to be hedging your risk. Even if you're bullish on the stock market, you want to be aware of the downside risk. Now, that's about all I wanted to say in this video. I hope you guys enjoyed. If you did, don't hesitate to drop a like and subscribe to the channel if you haven't already. In the meantime, good luck on your trading and see you next time.